Well, welcome to another episode of Insurance Gone Wild. I'm your host, Dennis Settlemar, and our lovely co-host, as always, is...
Stephanie Lencioni.
She always says that the same way. Stephanie Lencioni.
Oh.
I repeated it.
I was like, oh my God, is he going to say it the right way? But no. It's not even right if you say it the right way now. Like and we're going to talk about this at the beginning of every episode.
Probably.
So if you don't want to hear this, you need to fast forward about 30 seconds.
That's right. About 30 seconds.
Yep.
Hit the fast, the little
boop, boop.
3/4 square, 10 seconds. That's it.
And then here we are. Yep.
All right. So we're going to talk about a little bit today. This is going to be a short one.
Yep.
Today. And some of you that listen to these are probably going to be like, thank God. But this one's really pointed to more commercial.
100%.
Yeah, commercial
business owners.
Business owners.
Yep.
That's what we want to point this towards. So one of the things that we helped sponsor a dinner last night.
Yep.
And we had a number of business owners that we know come and enjoy a nice dinner and listen to a concept that's not a brand new concept in the insurance world.
Nope. It's
been around since, do you remember how long it's been around?
Since the 50s, 1950s.
Since the 50s.
By the way, that's 80 years.
Like 80 years.
Well, 70, I guess. 70.
Yeah.
50, 70. Yeah, 70.
Yeah.
70-ish years.
Yeah.
Yeah.
Waiting on you to you got the math
Sorry, it's
done.
bad math. I drink. It's fine. Yeah, it's fine. It's fine.
Well, you have kids too, so you've lost a few brain cells.
Yeah, no, it's been a lot this week. But so it's not a new concept.
This is not a brand new concept. And that's one of the things we wanted to share with the business owners last night. And so what it is creating your own insurance company so you can self-insure aspects of your business. Or if you're someone who owns multiple businesses, aspects of your businesses, insure aspects of your businesses, right?
Yeah. And this is not, and so it's called captive insurance, right? Mm-hmm. And even the people who help set these up are saying, we are not trying to replace your everyday workers' comp liability, all property. Of these things. We're not trying to replace these. Mm-hmm. This is just it's another vehicle that can help. So this is not a replacement. I just wanted to make that distinction.
Correct. This is not in why would we say we're helping clients with this? Whenever we're doing insurance, why would we help them do their own self-insurance? Well, this isn't competition for what it is that we offer.
Correct.
And so this is something a little bit different. So we're going to try our best to keep it very simple because if we aren't careful, we will get in the weeds and we don't want to do that. So we're going to keep it very, very simple. So Stephanie, last night was, we had a number of people there, and from the conversation that we had last night, and we actually learned a few things last night.
Oh, absolutely.
We learned some things last night.
It was very educational.
Even though it's something that we're starting to help people with. Mm-hmm. We have a team that we work with. It's not just us. It's a team of people that we're working with.
Absolutely.
And these people, this is what they do. This is what they do. They help companies, business owners set up their own insurance programs.
Okay, so let me ask you this. Mm-hmm. Can you give a brief synopsis? What is captive insurance?
Me, brief?
I know it's a lot to ask.
I'm going to try.
It's a lot to ask, but yet also a little to ask.
A little.
So it's both, baby. You just need a little to ask. No, just very brief little description.
I said we weren't going to try to we're going to try to stay out of the weeds, and here you're asking me a question.
Unbelievable.
Okay, so a captive insurance program,
just captive insurance, yeah,
is a captive insurance company that you as a business owner create to insure certain aspects of your business that your traditional insurance is not insuring.
Perfect. Okay. I love, and you said this earlier, and that's why I was saying, hey, that we're not trying to replace, but I do love that it is aspects. Mm-hmm. That is a huge nugget out of all of this for people to pick up on. It is aspects. Mm-hmm. This is not, we're not replacing, it's aspects. So yes. Yeah. Okay. So perfect.
So
I love that.
That's the nutshell. Mm-hmm. The purpose of it is to protect.
Like normal insurance.
Like normal insurance, going to protect you against certain types of losses.
Yep.
So from the dinner last night that we put on, what were some of the things that, what were some of the other purposes of the captive insurance program?
Well, okay, yeah. So the purposes, what stood out the most to me is, I think like anyone, like the attention getter is it decreases taxes. Right. So, I mean, let's first and foremost decreases taxes.
What taxes? I think that would be, what taxes is it decreasing?
Oh, business taxes, like what you're paying with your business,
on
right?
Their current business.
On the business, yes. And so,
and it can decrease it significantly.
Significantly, right? Yes. So they had 3 pillars that they talked about, and it was building wealth, decreasing taxes, and protecting the business.
Correct.
Because what is insurance? It's there to protect the business. And you said that earlier, right? And then of course the tax thing I think is that's the attention getter, if we're being honest. And then the really big bonus at the end where it's like, oh, well, that's really cool too. And then what keeps your attention is the option and kind of the vehicle that it allows to, quite honestly, create generational wealth. So if you didn't think that you could before, but like this could be a generational wealth creator for you. And then if not, then it just is a wealth creator and builder there. So, and then of course it's an insurance company. Yeah.
At the very basis, it's tax savings.
But the big thing again, yes. And that's the thing. I think the number one thing where we're going to catch people's attention, what catches my attention every time when they're like, oh, do you want to save on taxes? I'm like, hell yes. What do I do? Is it legal? Okay, great. I'm in. And then, so those are the 3 things they talked about. And the taxes are great.
Now, we had mentioned that this has been around at least 50 years, if not
since
longer.
the 50s.
50. So 70.
See, now you're going to do math.
70 something years.
We're
so
70-ish years, yeah.
Do you remember the particular IRS tax code that this falls under?
Indeed, I do, sir.
What is it?
It is 831B.
An 831B.
As in boy.
That's right. 831B. It is estimated that way over 90% of the Fortune 500 companies have their own captive program. It's a way for them to deduct majorly on taxes.
Yep.
Also, put in the money that they take out of their main company and put into the captive is deducted, but also the money that's in the captive is deducted. So again, for me, not getting into the weeds, the only thing that you really need to understand is it's one of the few tax strategies where you can double dip on deductions. That's how come you save so much money by creating a captive insurance program, your own insurance company.
Okay. So, and what I would just piggyback on that is, you were talking about, number one, I need everybody to understand and hear, we are not CPAs. We are not tax professionals. This is just, so just understand that when we talk about taxes, you need to, confer with your accountant, CPA. The other part to that is, yes. So essentially it's a business owner or a business having a pool of money, a pile of money that's sitting there, cash on hand. And instead of paying taxes on it, they move it over to the captive. And now it is a tax deduction and they are not taxed on this money that's still sitting there. So it's still their money.
Correct.
But it's not taxed. So that's the double dip, but that's the weird whatever, but move the money, pay for the insurance company.
Yeah. And
then you're not taxed on having the money sit there. So you're paying yourself for it. That's captive, right?
Here's a question for you then. So we just said a little earlier that this isn't going to replace your general liability, your property, your health thing. It's not going to replace those policies.
Right.
But inside this captive insurance company that you create, and it's a company that you create, there's going to be policies written that the money that's in your regular company is going to pay the premiums on these policies that are written. That's how you help fund the captive insurance company that you created. But if it's not covering general liability and property, what kind of stuff is it? What kind of policies is it? Are you having that right for you?
Right.
What kind of policy? What's it covering?
So one of the things, so it's covering stuff that's typically excluded, right, on those GL policies, or it's covering something that you now want to exclude from that standard policy to help. So you think about a home and auto or a homeowner's policy. If you could get a 1% these days in the Dallas-Fort Worth area, but if you take your wind and hail deductible and increase it from 1% to 5%, what does that do? It drastically reduces your premium.
Correct.
So then if you took that, and again, this is just an example talking about so people can understand the concept of it. And then now you have a 5% wind and hail deductible, which is essentially your roof, right? Which is you're self-insuring the cost of your roof. And then you go over here and you build a policy that protects your roof. It's going to cost you so much less over here in the captive world to fill in that gap.
Yes.
So you are now paying yourself, essentially just transferring the money. So you're not quote unquote losing it, but you're also saving on your premium to another insurance carrier that you'll never see again, whether you use the policy or not.
Yeah. So instead of paying Travelers or Philadelphia or State Farm or Hartford or whoever.
Name it. Yep. Then now, so that's what it covers the things that are not covered either ever on your GL, like general liability, and the things that maybe low risk, low probability of happening. Like take COVID, for example. A lot of people had, or some people, I think it was probably laughed off quite a bit beforehand, but a coronavirus pandemic. That was one of the options that people had prior to 2020. And had anybody had this coverage, I think COVID messed up a lot of people, obviously, right? And so this captive would have been a very inexpensive way of protecting your company for that. And then it would have paid you out for that your typical GL policy would not have covered. So just as an example, so it's the stuff that might be a low frequency of happening, but if it happened, could be devastating to the company. And then the other part is, let's say you take your GL, again, it can happen to your deductible. So you can raise your deductible to a very, very high kind of level that wouldn't be feasible to really take on, right, as a standard business. But then you build in this captive policy and you're like, okay, well, yeah, I can cover the $250,000 deductible that I've now just built in because I have this other policy.
Correct.
Anyway, I don't know if that was.
Yeah, no, that's exactly the kind of stuff I was thinking. As you said, I think the other thing you just brought up at the very end was what I was thinking was the $250,000 deductible. I mean, you get into some of these big property deals, you could have $150,000, $250,000, $500,000, even $1 million deductible. Yeah. Well, you have to keep some money on the books in order to protect yourself in the event that you're not playing the old poop game. Now I got to come. Well, you can take, if you've got that cash, or at least some of the cash, you could put it. You possibly could put it into your own insurance company, which will also have its reinsurance, which means that the reinsurance company is an insurance company for your insurance company. Travelers and State Farm and Farmers and Hartford and Guard and Berkshire Hathaway, they all have their own reinsurance company. And most of the time, in your case, or in a case for this A31B plan, is the reinsurance company is going to pay 51% of the claims of whatever. So if it's $100,000, they're going to pay $51,000. You're going to pay $49,000. So
out of that
means you're not on the hook for everything.
Correct. And that means, so again, great. If you increase to your 250, or we're going to say 200 because it's easier, but this is the same thing, right? So 100,000, 200,000. Well, if you were trying to save insurance premium money and raising your deductible, then you had to have it on cash on hand. Or if you didn't have cash on hand, then you had a line of credit. And then as soon as you start touching that line of credit, what are you doing?
Oh, you're paying interest.
You're paying so it doesn't just cost you 200,000 or 250. Yeah. Now it's costing you that plus the interest over the term of the loan. So
put
to
the money,
mitigate,
put money in the company, and you're in your own insurance company.
Right.
You can take that money and invest it.
Mm-hmm.
So now it has potential to grow. Right.
Yep, absolutely.
Whereas if you just leave it on the books, it ain't growing. You're getting taxed on it. At least the first year around, you're getting taxed on it if it's sitting in your account, because it's, it was profits.
Yep.
And depending on where your tax bracket is, could be as high as 40%, 40%, whatever it is. But yeah, you just take that money and you move it, or start making, figure out a way to make payments to yourself through there's all sorts of ways you can use a captive insurance program. Create your own insurance company and insure your stuff. It will grow historically, because everything's based on the stock market. You can't say that it will grow, but historically over time it grows. So you invest it, you take the profits out, you put them in a third company that you create called a holding company. And that's where you get into the generational stuff.
Yep. I'm going to stop you right there though. So one of the points that was made last night that was really interesting, he was like, so you think about it, like, even if it doesn't grow,
mm-hmm.
if you've taken your money and you're at that 40% tax bracket, and so let's say it's 500,000, whatever it is,
mm-hmm.
and you decide to put it over, or 100, let's go easy. We'll go 100,000 over, and it doesn't grow. Well, but just still made 40% because you weren't taxed on it.
That's right. You still save 40%.
So even if it doesn't grow and it stayed the same,
mm-hmm.
you still had gains.
Yep.
The gains were still, but even on top of that, you can have a chance to go, higher and above. It was just an interesting concept.
Yeah,
I was like, good one.
You get into the third company, the holding company, where you can transfer the profits from the insurance company that you created.
I'm sorry, did you have a question for me?
I am. I'm getting ready to ask you a question.
Okay.
So you get into, let's say that your insurance company is making money.
Okay.
And you want
claims.
You want to transfer those profits to the third company that you create called the holding company. So you put the money in there, your profits in there. What can you do with the money in the holding company?
So much.
Yeah.
So, that is, to your point, like where the generational wealth can happen, or it helps.
Be generous,
it doesn't have to be, but it just builds wealth in general, right? That's that third tier he was talking about, which was build wealth. You can loan it out to yourself. Now it is, as we talked about earlier, it's a contract. It's a real loan. You are paying interest on it, but who are you paying interest to?
Yeah.
Yourself.
Correct.
It's your holding company giving yourself a loan.
Yep.
You're paying interest back to your holding company.
Yep.
So you're paying it, but you're not. Yep. Right. Yep. And so it's an interest-free loan. You're going to get the loan from somewhere. So you're going to go to a bank, or you get there's that. You can do the dividends. And so the dividends from that, I think they said they were at like 15 to 20%.
It depends. Yeah.
Depends. But it's not at the 40 that you were initially at.
You're taxed at 15 to 20% off the dividends that you take.
Off the dividends.
Versus the 40% you would have been taxed on.
For doing nothing. Just having it. Yeah.
Yep.
And so, but that's if you're not doing a loan. If you're just doing a dividend, then you're at the 15, 20%, which again, that's a 20% savings.
Yep.
And it's even more than that though, because you're not taking the full amount.
Yeah.
So you're taking what you need opposed to what's just sitting there. And then you're also not wasting, because one of the things we talked about, I don't remember if it was in this, but what do a lot of companies do at the end of the year? Because nobody wants to pay taxes. That is the worst. Nobody wants to pay taxes. So you've got things like construction companies and like, oh, we've got all this cash on hand. What do? We buy equipment we don't need. Oh shit. That bulldozer looks nice. It's pretty. Maybe I can bedazzle the steering wheel and then have it, and then it's going to sit there. Or
you didn't need it.
But you didn't need it. And so, or you put in this, and then what you do take out isn't that full amount that's just sitting there. It's the part you truly want. And so it automatically is less. And then the tax bracket's less. Does that make sense?
Well, it does. It does make sense to me.
Yeah.
I
Hopefully
think
we didn't lose.
Yeah, I thought you explained as well as it could be explained.
Thank you.
The bottom line is there is something called we're going to wrap it up because it's going to be a short one. There is something called a captive insurance program where you can create your own insurance company. You can create policies within that to protect certain aspects of your current business. The premiums that you pay from your business into your own insurance company are tax deductible. And the money that's in there can grow, and you can take the profits out of it and put it into a third company, and you can start using those profits for a variety of things.
Buying new companies.
You could buy another company. If you've got enough money in there, you can loan yourself back money for whatever you want to do. There's a lot of things. You can buy life insurance with it. You can do tons of different things with it. So, but it is something that's been around since the 50s. Mm-hmm. And it is proven it can work. You have to be very, very careful how you set it up. You can't just willy-nilly do it. You have to go with somebody that knows what they're doing. And guess what? We know people.
What?
Yeah,
Get out.
Yeah, the people we're partnering with. They know how to do that.
What's that really cool website that you were talking about?
Oh, yeah. You can go to Panatella, Panatella Advisors. Panatella advisors.com. Give you some good overview information to start. It's going to, I think, stimulate more questions for you. It is a question and answer type of setup, but
Perfect.
There are going to be things that you're going to be, I wonder if it works for this. I wonder if it works for that. And I would say there's a very good chance it will. So it is a great tool. It's a great strategy to help you save on taxes. And who in the world thought you could save on taxes with insurance?
I know. Well, and not lose your money.
That's right.
And that's the thing. So insurance, in my line of business, and it goes the same with all of it, but I talk about, because I do the health insurance, the group benefits and everything. So we talk about guaranteed money, guaranteed cost, which is your premium. And then your what if cost is hey, do you actually have to use it? Right. And so that's the same thing. But with this, you're saying, yes, it's still guaranteed versus what if, but you've lessened everything. You've saved on taxes and you've still protected. And so it's a huge, huge benefit. So let's talk about this before we completely wrap up. What did they say last night about minimum of who should even start inquiring about this?
If you have $1 million,
keep it clean,
$1 million in gross sales.
Yep.
This could benefit you.
Yes.
$1 million in gross sales.
Yep.
It doesn't mean $1 million in cash. $1 million in gross, or $1 million in
gross revenue.
Gross revenue. It doesn't. I'm saying it doesn't mean $1 million in gross in profits.
Absolutely.
It's a gross revenue.
Then it's at least worth having the conversation.
That's correct.
It is no cost to have the conversation, to do an evaluation. What our team will ask is, first and foremost, what's your annual sales, your annual revenue, right? Gross. And then what type of business are you in? Those are basically the two big things initially. And then they will go through and they're the experts. And that's the whole thing, right? So you get a certain insurance agent or broker because they're the expert. You don't have to be the expert in it, but you have to hire the right expert. And then that's essentially the exact same thing. So there are, like anything, there are lots of wrong decisions we can make, wrong companies we can go with. So you just need to be careful.
It goes back to make sure it's set up correctly.
Got to be a credible company.
Yeah.
And that's the thing where we've got the resources. And you mentioned something earlier a while ago when we were just kind of talking, but if you talk to your financial advisor about it, but what percentage of financial advisors?
I was making it up. Very few will even understand what you're talking about.
95% of them probably don't know what we're talking about.
Yeah, I've mentioned it to some financial advisors that I know, other ones, and they're like, a what?
Yeah.
We've heard of it, but what?
So
and they're good. They're good at what they do.
Absolutely.
It's just not what they do.
So you just want to make sure you do get teamed up with people who understand how it all works, and the ins and outs and kind of intricacies of it all. But that's what we do. And that's the whole point of everything we do. How do we help our clients save money? How do we protect them? Obviously, because we're in the insurance business. And how do we just make life better for them? We want to be the resources for what they do and how they become better and how they can focus on your stuff. We'll focus on the other stuff and we'll help protect. You go do your business and then we'll connect you with the right ones.
Correct.
That's in a nutshell, right?
That's what we're trying to do is help out all of our clients in one way or the other, especially with our commercial clients. We talked about some programs we have for the personal stuff. We've got more coming. We'll talk about that. We'll probably revisit that one because storm season coming up and some of the stuff that we have is really focused on wind and hail and things like that. But anyway, on the commercial stuff, this is something that's outside of your normal just insurance conversations
for now. But it's gaining traction, and that's 25% of insurance policies are captive policies.
That's correct.
And that's huge, guys. So the reason we say that is because you're not going to be the guinea pig. Because it's not a universal, homeowners insurance. Oh yeah, auto insurance, a deductible for, for whatever. It's not normal standard practices, but it's still 25%. That's 1 in 4 policies. Yep. That's huge. Yep. So it's there. It's been proven. It's been all of the different things. So again, nobody's getting guinea pigged. No one's getting bamboozled. But it's about check out panatellaadvisors.com and we can then connect you with the right people. You get a free consultation. Is this a good fit? Do you want to move forward, get more information? If not, it's fine. It costs you guys nothing. At this point, my big question is always, what's the risk? What's your risk to make the phone call and get the information? 0.
Lost 10 to 15 minutes of your time that could have saved you tens of thousands or hundreds of thousands, or if you're big enough, millions of dollars.
Yep.
That's it.
So
15-minute phone call. Is it worth your time?
Is it worth your time? What's the risk? Yeah. It is. Yeah. So that's all we have.
All right. Well, thank you guys for joining us again. This is Insurance Gone Wild. As we say every episode, reach out to us. We can get a hold of us at contact@igwpodcast.com. You can email us there, or you can give us a call, 817-753-0093. Thank you all for joining us, and we'll see you again next week.